Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 26th of September. We're banging on the door of the end of the third quarter. And sadly, for the neighborhood of the Gulf and the oil producing center of the world, we're also knocking on the door once again of a $70 Brent crude oil price, which looks like it took a major hit this morning once the news came out on the FT that Saudi Arabia was ready to abandon a $100 crude target to take back market share. That was the headline that flew off the pages this morning. And I'm not sure if that was the trigger, but it certainly looks like the timing aligns with that. Let's start this morning with Kate Durian, the MEIS contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Kate, you and I have been around a while, that we've seen this show before. Hasn't worked out so well previously. Your thoughts on this strategy now? We presume the FT reporting is accurate.
Yeah, I mean, it's not really sourced. It's not sourced to a particular person, but you know what is said in public and what is done. But I think it is true. And if you listen to all the analysts, Saudi Arabia now does need a certain level of price. But you know, as they prepare, if they're going to start increasing their production from next year, then I suppose you've already abandoned your $100 target. But I think, you know, that's pretty unrealistic. I mean, nobody's thinking that oil prices are going to rise to 100 per barrel because you've got so much spare production capacity already. You've got about 6 million with all the cuts from the OPEC plus producers, and you've got, you know, new supply coming from Brazil and Guyana and the US. And so I think that's going to make it a lot tighter market for the OPEC plus to maneuver. But again, you know, you don't control the price. It's a market that does it. And there's, you know, you've got geopolitics, which haven't really had that much of an impact. You've had, you know, shortages. You've got supplies cuts in Libya. You've got the presidential election coming, so nobody knows how that's going to go. Are you going to have more sanctions against Iran, against Venezuela, against Russia? So it's all up in the air at the moment. And I think it's you know, the market is becoming more complicated. You're seeing a lot more sophisticated trading. So I don't think they can actually say, you know, this is the price target we want. And you and I know, whenever they've set a target, they've missed it. So
Let's welcome Andy Critchlow, Global Head of News at S&P Global Commodity Insights. I haven't had the chance to say that before. Global Head of News. Mabruk, congratulations. Well deserved, Andy. Your thoughts on, I mean, in some ways it seems, we were even talking about this on the podcast a few weeks ago, that this market share fight was likely to happen. Saudi Arabia has been carrying the freeloaders for a few years now. Ultimately, the day of destiny, as we approach peak oil, somebody's got to go.
Yeah, absolutely. I mean, I guess the question is it too little, too late from Saudi Arabia? If, you know, in terms of this messaging now, have they let the market kind of get away from them? You know, our latest call forecast for Brent into next year is $77 a barrel for 2025. We're down to $83 a barrel for this year now. You know, that's and we're already below that, right, heading into the winter. I think, you know, it seems the context around this is some of the bleak news around demand growth going forward. We saw a lot of this, heard a lot of this at APEC in Singapore last week. A lot of concerns about Chinese demand. You know, there's a kind of a big shift really happening in the oil market at the moment. And we talked about this actually a couple of years ago, that you've had since 2001, China joining the WTO, you've just had this like constant trajectory of expected, growth in Chinese demand, and exponential in a way. And that's now starting to, peak in reality. And what's driving that? Well, it is the declining working age population in China. It's the rapid electrification of transportation in China, which is happening much quicker than people thought. And I think from my conversations with policymakers around OPEC, is that they're starting to listen to this. They're hearing this now. So, I think that all of this feeds into that narrative, this abandonment of quote unquote the $100 a barrel oil price target. I think that if you'd said that, to the Saudis, is your oil price target $100 a barrel? I think they would have denied it and got very angry about it. So, but unofficially, probably, yeah, that was kind of what they would have hoped for, slightly unrealistically. But the market's still very fragile. I mean, we've seen over the last week in terms of the various negotiations going on in Libya to appoint a new central bank governor. You've had a $2 to $3 bump in light sweet crude differentials in the Mediterranean over the last month, and now that sentiment's turning much more bearish because of that Libyan crude that's expected to come online. You've had one of Libya's biggest refineries, Zwatina, offline as a consequence because it can't get the crude. Now, if all that starts to come back, you get even more bearishness filtering into that European market. So the market's still very volatile.
Let's welcome Mark Howson, head of Asia and Wellington's Analytics, sitting in Singapore, probably one of Asia's best LNG analysts, Mark. And I think that's a good point to start our conversation with you, because as we try read the tea leaves, and Andy did a bit of it there on the health of the Chinese demand story, the health of the Chinese economy, it's clearly one of the big bearish factors in all commodity markets this year. Your thoughts? What does LNG pricing and demand in Asia tell us about the health of the Chinese economy?
Thanks for having me on, Sean. And it's a little bit of a different story, and in some ways quite an opposite story on the LNG and gas side in China, because we've noticed this year it's been particularly robust. Obviously, European LNG imports have reduced significantly, down by 20% in the first half of this year, because of course gas storage levels are particularly full there at the moment. But that slack has been more than made up for by this very strong demand in Asia, particularly China and India. And LNG demand in China was up 3.5 million tons in the first half of this year, up 10%. And China became the world's largest LNG buyer last year with 71 million tons of demand. And we expect that to be 80 million tons by the end of this year. And a lot of it is for the reasons that Andy mentioned in terms of the environmental regulations, particularly in that transportation sector and the electrification of vehicles, but also increased tightening of the rules around diesel usage for vehicles around the big cities, and natural gas just penetrating that sector even more. And of course, that's been facilitated by the big increase in regasification capacity that is currently under construction in China as well. So China strongly growing, India strongly growing as well. Now, some of that was seasonal because of the particularly hot summer period around the monsoon time in India. So that's very much power demand driven, because of course Indian LNG demand was up 25% year on year in the first half of this year. But also across Southeast Asia, it was particularly strong for LNG demand first half of the year, including Thailand as well. That was up 11% in terms of their import. So weaker European market, but very much more than made up for by Asian growth. And that's what kept these LNG prices still pretty elevated, above $13 per MMBTU here in Asia.
Kate, I mean, one of the things that this is the sort of second big shoe to drop this week from OPEC. I mean, if you take the Financial Times reporting on face value, it's the second kind of major shoe to drop from OPEC this week. And the first one being on Tuesday with the World Oil Outlook report, where they put in the market a very, very bullish. I mean, last year it seemed that they bumped it up. It seemed incredibly bullish. Now they've even gone further, which is nearly an extra 20 million barrels in crude oil demand over the next 25 years, way, way beyond and out beyond, everybody. And here we have this news of the possible market share war, oil price war that the FT is indicating that Saudi is looking at. Those two things are quite incongruous, because if you think there's a huge demand growth, you want to encourage every high cost producer and everyone else to start pumping. So I'm wondering your thoughts on putting those two things together this week.
Yeah, I mean, I'm just wondering how they're calculating, primary energy demand growth. Because if you look at the IEA and the EIA, they've actually changed their methodology because, as you get growth in renewables, you're talking non-combustibles. It's not easy to compare apples with, you're not comparing apples with apples. So I don't know if OPEC has actually changed their methodology, but I don't think that explains the fact that they're expecting, oil demand to go up from 100 and whatever it is now, 103 million barrels a day to 120 by 2050. And if you look at the IEA's projections, forget about the business as usual projection by the IEA, which sees much lower. But if you look at their net zero report, which really got the Saudis and other producers very angry, you're talking about a quarter of current demand, about 25 million barrels a day or 27 million barrels a day. But at the same time, I think you have to go somewhere in between, the two forecasts, because the energy transition, yes, is moving ahead, but it's off track. If you look at the latest IRENA reports, they're off track. You're going to have to go from, particularly on EVs. Okay, China might be a very big market for EVs, but elsewhere it's slowing down. But you will see growth, but you're going to have to grow from 30 million cars of hybrids and EVs on the roads today to nearly 360 million by 2030. That's about 6 years. So that's really difficult to see. Everything is off track. You're going to need to invest in grids. You need about 55 million kilometers of grids being modernized or repurposed for, to absorb all the renewables that are coming in. So I think it's sort of, maybe that's a bit unrealistic, because you are going to have, demand is going to flatten. It's not going to be as robust as OPEC expects, 2+ more million, and we're nearly at the end of the year. And they've come down a little bit. They've revised down their demand just a tiny bit. So I think if you look at the investments that are going into increased capacity, you've got, UAE is close to its target. Saudi Arabia stopped the 1 million. You have to think of declines as well in your natural decline from existing fields. So if people aren't really investing, then you're going to have about 4 or 5% decline. But I think it's a bit too much to expect. That the transition is happening. It may have its ups and downs, but I think electrification is growing. You're getting more money going into non-fossil fuel investments. So I think there are maybe a bit of wishful thinking there with their forecast.
Andy, the news reporting today on the FT article, they're going to increase supply. That's obviously not, in some ways, is not news, because of course they committed to increasing supply 6 months ago or so, that from October 1st they would be in doing so, and then they suspended that 2 weeks ago to start on December 1st. So this is not a new story. In essence, ultimately, we didn't know if they were going to suspend it again, but this is being framed in a kind of different light, i.e., price war, market share war, rather than as it was presented 6-8 months ago as part of returning these cuts that they've made over the last few years. But my question ultimately, in the middle of all those cuts, or the returning strategy that was announced earlier in the year, one of the pieces of that puzzle was increased production quotas for the UAE, who have significantly increased their production capacity in recent years, spending a very large amount of money to achieve that. With that sort of parked as being a kind of something that's hard to see the UAE was ever going to give up on, this announcement through the FT from Saudi sources is kind of inevitable because the UAE is not going to stop on this journey. Your thoughts on some of the internal machinations of OPEC in these decisions?
Yeah, I think it's a really good point. And, to what extent is this just driven by Saudi Arabia or, the other members, and, their plans to increase capacity or desire to have, more quotas? I think compliance and adherence to compensatory cuts is a challenge. I don't think there's any secret in that. I think if you look at the UAE, for example, UAE production is questionably close, shall we say, to UAE exports, which raises the question, where's the gasoline for all the cars in the UAE coming from? And where's all the jet fuel for the airlines that flying in and out of Dubai coming from? The UAE is a pretty chunky consumer of hydrocarbons as well. And when you get production and export so close, then clearly people are going to ask questions. Similar questions I think get asked, every month around Iraq's production, and Iraq gets a lot of focus, but probably unfairly actually, because I think this whole issue of compliance across OPEC has become very, very challenging. And certainly from the perspective of journalists looking at that OPEC story, that is probably the number one thing on their list every week to look at. How are these countries doing with their compliance? How close are they to meeting their compensatory cuts, and that has inevitably become more challenging as the oil price environment has become more bearish. Is this a story that you're going to have a change in strategy from December, although it is just carrying through on what's already been said, but it really does cast it in stone if it is actually the case, then is this an admittance that you can no longer kind of hold everyone back? And we haven't even started talking about Russia. And actually, the market really does not know, in truth, how much Russian liquids are actually in circulation at the moment. We've got a vague idea on crude, and there's lots of tanker tracking and lots of different people looking at that, but look at the issue of Russian condensate. No one really knows how much Russian condensate is going into the market.
And the other part of that, again, this reporting from the FT, the market share fight, is that Russian oil is now become a permanent feature in the East of Suez markets, where this is a sort of the home turf of the Gulf producers.
Absolutely. When you talk to the Gulf producers, many of them are really concerned about this. The market in India has become much more competitive for Saudi Arabia and Iraq, for that matter. The market in China has become much more competitive, because of the presence of Russian crude in greater volumes, and that's not going to change, because even if you get a settlement with Ukraine in 2025, US sanctions have proved historically to be very sticky. Just look at the situation with Iran. And I wouldn't see that you would have an immediate easing of US sanctions or indeed price caps, unless you get dramatic political change in Russia that the US was willing to support and wanted to provide some economic incentives for. But that's very much an unknown. So even if you do get some sort of geopolitical easing, be it in Russia or in the Middle East for that matter, I wouldn't see US sanctions, which are obviously making it harder for Russia, going away anytime soon.
Mark, one of the things we're trying to understand as we look to Asia, and obviously in particular to China, about the peak oil era, that we're kind of in peak. We heard announcements in APEC in Singapore 2 weeks ago that we're very close to peak gasoline consumption in China, and even CNPC, the China National Petroleum Company, has announced that they see peak crude oil demand sometime in the next 5 years. But my question ultimately is, where is gas as a transition fuel in China? Where is the outlook for LNG? Because it seems to me the only thing that's growing in China is coal consumption and coal imports and coal to power generation, and that gas and LNG is not displacing that space. Your thoughts on where gas LNG as its role in the fuel mix in China going forward? If oil is peaking, where's the transition piece there? Your thoughts?
Yeah, thanks, Sean. Certainly what we see in China is certainly right through 2030. I mean, as I say, we expect 80 million tons of Chinese LNG demand this year. We expect it to be over 120 million tons by 2030. And bear in mind, we do have this huge wall of LNG supply, the 50% increase in capacity from traded volumes, which were about 400 million tons last year, up to 600 million tons of capacity on the supply side by 2030. And obviously that's going to put downward pressure on prices, particularly from the second half of next year as the Canadian and US plants start to ramp up. So just facilitated by that increase in supply and therefore lower prices, plus the regasification build, we certainly don't see peak gas demand anytime soon. And what to us is very interesting, Sean, is what the players are doing on the contracting side. And if you look, the Chinese have been very, very happy to sign 27-year LNG contracts, particularly from the Qataris over the last year in particular. So it certainly doesn't indicate to us that there's peak gas demand anytime soon, because like you say, there's obviously latent demand growth, and in particular eating away at the liquids fuel proportion of the energy mix there.
Let's go to the survey question and get the view there on this reporting today. The FT reporting that Saudi Arabia is ready to launch oil market share battle. Can they win? Yes or no? We've seen it in recent decades and recent years that after shale exploded at 10, 12 years ago, it was very difficult to tame that. Can they do so on this occasion? Ultimately, Kate, if one is following this train of thought, who are you competing with? Who would Saudi and OPEC, if they're indeed sort of speaking on behalf of the group as a whole, be having that market share battle with? Is it more likely to be the energy transition and wind farms in the North Sea, or is it Exxon drilling more oil out of the Permian Basin? What do you think and where do you think they should target their fight, if you like?
I mean, I don't think you can win this. I mean, you can't control prices. The market controls. I mean, the market determines the price. And as I said, trading is becoming more sophisticated. It's becoming more. It's out of their hands, really.
But clearly, they've seen successful outcomes from cutting supply. By keeping 6 million barrels off the market, it does elevate the price.
Yeah, but I mean, do you cut your nose to spite your own face? They need a higher price. Maybe not 100, but they do need a higher price. They're already scaling back on some of their mega projects. So I think, the Saudi economy is doing quite well at the moment. Inflation is under control. The banking sector is quite solid. But at the same time, they are relying so much on Saudi Arabia to provide the royalties, to provide the funds to the PIF, to the state. It's not sustainable. So I think to launch a price war. I remember Naimi once saying at the time it was Russia that was in their sights, and he was saying, well, if the Russians want to see $20 oil, I'll give it to them. But I think to say that you can actually determine or have a say on what happens in the market, I think is difficult. I mean, look at it. I think 70 at the moment seems to be a floor. It goes up 75, it comes down again, despite all the issues that are going on. The Middle East, the war, the uncertainty of the US sanctions. But again, are you going to be hurting your ally in OPEC plus Russia by launching a price war? Is it US shale? I mean, if Trump gets back, he's going to drill, but the market doesn't really need it. So, it's easier to talk and say, oh, we're going to do this, that, and the other. Yes, they may be able to control in the near term, but I think, with production capacity, but again, there's overproduction. You've got the UAE. I mean, I was recently talking to one of the equity, making a presentation to one major company that is an equity producer, and they said the numbers you're seeing are too low for UAE production. So, there's a lot of internal friction within OPEC Plus. So I don't think you can, unless you work together, which they're not at the moment, and make sure that people adhere to their production cuts, or there's just too much leakage at the moment.
Andy, since we've started our podcast, we've seen oil recover. I'm not sure there's a correlation there, but after the sort of sharp decline early this morning of 4+%, it's now come back a bit to being a 2% drop so far. But it just leads me into my question to you, like, if one was to follow this through the through line, as we said earlier, OPEC and OPEC Plus had announced earlier this year a very clear plan to increase supply by X number of barrels every month and X number of barrels by every producer and so forth in very granular detail. In reading through the FT reporting, it kind of indicates that would be abandoned and it'd be like pump what you can or what you want, although this is all very early days in the reporting. But if one takes that follow through as the logic being, a market share war is not something achieved through announcing incremental increases every month. It's basically turn the taps on. And if you follow through that logic, my question is, how detrimental would that be to prices? How far could they go? Who would be the first to get a whack? You're just sort of follow through that train of thought and how that could play out.
Yeah, it's a good question. I think it's if this is a distinct change in strategy, and if you look at OPEC since 2015, creation of the cooperation agreement, which many people doubted at the time, for many of the reasons which Kate mentioned, this for well over a decade, OPEC had seen Russia as a major competitor and was primarily the target of the market share war that Ali Naimi waged for many years, and Shell as well, but Russia, very specifically. And there was a great deal of skepticism. So it was a big bold bet, the cooperation agreement and the enlargement of OPEC. And I think that my question around this is if they are changing strategy and if that is led by Saudi Arabia. And Saudi Arabia, I think it's fair to say, over the last 5 years has become bolder in its approach to OPEC, and my justification for saying that is that almost 6 million barrels of oil that's currently idled as part of the strategy. Now, if they want to take another bold bet, well, logically you would say you could flood the market because they've got the spare capacity to do it, and you could do it in a very short period of time. And then when you have all this bearish sentiment, all this uncertainty around Chinese demand, then you can get to a plausible argument that you're going to get very low oil prices very quickly into next year. I think that history shows us in terms of market share battles, and you could make the case that where Ali Naimi failed is they didn't go hard enough. And yes, there's going to be economic, pain as a consequence of it. But, Gulf economies have done exceptionally well over the last 5 years. Sovereign wealth funds are well stocked. Reserves are pretty chunky. Yes, there's economic strains in terms of capital investment in Saudi Arabia, in diversification, but much of that can be mitigated by debt. If you look at the economics, debt to GDP ratios in the Gulf are amongst the lowest in the world. They've got a lot of headroom. So if this is a real serious change in strategy and a real objective to win a market share war, or in this instance, if this Zoe is true, start a market share war, then I would think that they would be bold in their approach to it. But this again is just making a number of assumptions.
It is a number of assumptions, and obviously the reporting under the FT this morning is early days, but I'm sure every energy OPEC journalist in the world will be working the phones as we talk here. Just to wrap up quickly, Mark, I wanted to get this moment as we go into the era of cheaper money with the Fed cutting 50 basis points last week and indicating more to come, where that impacts the outlook for investing in hard LNG infrastructure in Asia was something that has always been the missing key point. In essence, we're seeing in Vietnam the first power plant using solely LNG to start early next year, the Dong Nai in the Dong Nai province. Where is the appetite, the access to capital for more of that going forward in Asia in order to sort of lock in this big obvious appetite for LNG?
Well, actually, where we're seeing a kind of rejuvenation of interest, Sean, here in Asia Pacific is actually particularly on the supply side. Now, like you say, some of that is driven by the kind of interest rates cut coming from the Fed in particular, but also given some of the internal political uncertainty in the US. Obviously, President Biden had his pause on issuing permits for new liquefaction projects to export to non-FTA countries. And then there have been a few environmental challenges at a federal level, challenging the regulators' permit to export to LNG projects that are already under construction in the United States, combined with the fact that by the time you get to 2030, almost 30% of LNG supply will be just from that US Gulf Coast. We actually see renewed interest in the buyers in countries like Australia and Indonesia in particular, and trying to monetize some of the stranded gas reserves within those countries, particularly based on recent exploration discoveries by ENI and Mubadala Energy in particular in Indonesia, and harnessing existing traditionally underutilized LNG infrastructure in Indonesia to bring more LNG supply into this growing Asian market. So I guess it's more we're seeing on the supply side players in Asia Pacific really providing an alternative that's closer to the Asian market for LNG than some of the US projects.
Well, we're going to have to leave it there. We've got a yes, they can win by a small majority in this room, and we'll see if that is echoed across social media. We'll post the survey there. But we see Brent crude down this morning, some sharp decline after a fairly flat, uninteresting open, and then the news of the FT article, and the price dropped quite sharply. It's still down 2.5%. Will that hold, or as Europe and America opens and sobers up this market into new realities and more reporting comes in to explain this news out of the FT, we'll all be keeping an eye on it. But until then, we thank our commentators today. As always, great to have Kate Durian back at the table. Andy Critchlow, now Global Head of News. Again, congrats, Andy. And of course, Mark Howson with Welligence in Singapore. Thank you. Always great to get your insights on the Asian LNG market. Have a great day, everybody. All the best.
Thank you. Bye.
Thank you. Bye-bye.